All right, another one from the mailbag. This is from Mac in St. Louis. Are we on in St. Louis? You run in Missouri?
Yeah.
The show runs in St. Louis?
Yeah, it's a St. Louis market.
Why did I never know that?
I don't know. Maybe you can't remember anything.
Well, Mac is wanting to sell his business for $5 million. The CPA is telling me he's going to pay like over $1 million in taxes. And he's like, should I? And that's his question to you.
Yeah, I'll just go ahead and pay the tax.
Yeah,
Give
just
it to
pay the tax.
government.
Just let it go,
It's going to good things. Next caller. Go ahead. That's what's in the
I
mailbag.
know better than that. I know better than that.
Well, what we do is a comparative analysis, right? We show what's called a what if return. Here's what if you paid the tax, right? And on that amount, I mean, it's hard to tell because the capital gains rate are marginal, and I don't know.
It's not going to be 3.5 that you're coming out with.
Oh, it might be. Yeah.
Okay.
You might be netting 3.5 because it's still,
gosh,
and I have to look at Missouri state tax. I think they're around 5, like Virginia. But anyways, the point is with the 3.8% Medicare tax, you can be up there almost 30%. And because once you get over a certain income, then it's 20% capital gains rate. And so it's a problem, right? Because a third of your and what we find with business owners or real estate investors are very similar to business owners. They are so siloed focused. You know what that means? Like they don't have a lot of money in the stock market. They don't have money in IRAs. And they just put it all into that one thing because it was working. The guy's worth $5 million. Everybody, a lot of people are dreaming of having $5 million.
Oh, yeah.
Right? So the issue is if you have an IRA worth $5 million, you can slowly kind of take a piece of the pie over time. Right? You're not going to be in a 30% tax bracket every year, right? And so giving all that money up front just destroys the amount of growth that you can have on that. And so, you have to sit there and think about, okay, what can I do? Well, there's a lot of things you can do. It's just a matter of what's a fit for that person. Mac, the question I'd ask, are you a charitable giver? And if Mac says, yeah, we give to our church and we give to nonprofits, we help out a lot of United Way, and we give, because a business owner that's worth $5 million, a lot of them are charitable because they realize I don't need all this money, right? We had a business owner that's doing that right now. He's young, but he's like, I can't do this anymore. Yeah, I'm out in the next few years, and it's actually doubled that. It's about a $10 million business value, and he's like, but I've heard that I'm going to get nailed on taxes. You're absolutely right. Whoever told you that? You're going to probably pay 2.5 because their cost basis. The problem with business, you depreciate them, right? And there's no cost basis, like you paid $1 for the company. And so, you're going to write a check for $2.5 million. So in this case, we back in to find what their goals are to find out what the tax strategy. Are you charitably giving? Oh yeah, I give $50,000 a year away. Okay. Well, there's some strategies there that can help eliminate, minimize, or defer the tax depending on which way you go,
and allow you to give more to charity.
Yeah, exactly. Everybody wins. You eliminate the capital gains tax. So you actually are taking income off of $5 million, and there's trust that you can set up to replace the money at the end of your life. There's pooled income funds, which we've talked about once or twice. I think we talked about a pooled income fund. That's a type of charitable trust that you basically eliminate the capital gains, right? It's legal, moral, and ethical. It's been around since the 60s. Isn't anything new. You're not hiding money in the Cayman Islands, okay? I mean, it's literally a legal tax strategy in the IRS code. Red Cross, American Heart Association, they all have pooled income funds. This isn't anything new, right? But it's a scale where you can control the investments. It doesn't have to be controlled by a big charity. And you get income for the rest of your life, and if you want income over the rest of your children's lives. For someone that has an estate tax problem too, it eliminates the tax for that, and that's where the real savings comes in, because estate tax over the exemption, which is very high right now, it's $12 million, but 40% has to go to the government if you're over that amount. It's crazy. You get tax coming in, you get tax going out, And so I think, we will look at, do you not want to do the charitable giving trust? Okay, well, we'll not do charitable giving, but maybe we do a deferred sales trust, right? Where you defer the tax. Not as great, but you still don't have to pay all the tax, and you can slowly take income, just like the IRA, right? You want to take 80 grand or you want to take 100 grand, which isn't a lot, right? I mean, 4% of $5 million is $200,000.
Yeah.
200. Yeah, it's about what I was used to earning. Okay, that's fine. We'll take that and get that to you for the rest of your life. And then if you want to have that for the rest of your life, but you defer the tax, and you don't have to pay tax on the interest, right? But you can switch it from a business to something.
Sorry, say that again. You don't have to pay tax?
No, you have to pay tax on the interest, right?
Because it's income.
Right, it's not tax-free, but what you're doing is it's opportunity cost, right? Because, just the gain, right? If on the tax savings alone, right? You have to do the math, because if you're earning 10% on $1.5 million, let's say he was going to pay $1.5 million in tax, right? Well, that's it's $150,000 a year of income.
Mm-hmm.
He's an aggressive investor, so he's going to invest in the growth stocks maybe, but even if it's half, that's $75,000 a year just on the tax savings. That's opportunity cost, and that compounding interest. Then you start looking at the long term of the kids, and they're in their 30s. Oh goodness, it starts to get a little crazy on how much the tax savings are. So there's a lot of tax trades that are legal, moral, and ethical that have been around a long time. It's just backing into, what do you want to do, Mac? Right? And sometimes it's a multitude on larger amounts like that. That's what you qualify for the private wealth division. We have to do a ton of planning. We're getting in touch with attorneys.
He qualifies, right?
Yes, he does. Yeah. But attorneys, specialists, maybe there's charitable gifting specialists or different type of specialists that are involved in that specific strategy. Well, we go into, we put their tax return in and try to, it's called exit strategies, right? People are looking to exit from their business, their real estate, and they don't want to get killed on stocks. And they also are not having to go, like if they're in real estate, they don't have to go back into real estate in some of these strategies, right? They can go into something else, something more conservative. They want to go in the stock market, they can do it. It's a lot easier to manage an investable account in the stock market than it is managing 50 rentals, right? Or an apartment building. And in that stage of life, when you're getting to that age, you don't necessarily want to do that.
Yeah. Sounds to me like Mac needs to call Integrity Financial Planning. 866-2-PLAN. For Mac, you've been listening, just make the call. 866-TO-PLAN and the number 4, or you can find us online at retirementplannow.com.